Good afternoon. Although once again, I got to apologize for my people in the West Coast. Michael Seminari, good morning to you. It's
Thank you.
11 a.m. And of course, since this is often replayed on YouTube, good morning, afternoon, and whatever dateline you happen to be coming into us from. So we appreciate the chance to be here today. By the way, before you start saying where the hell is Sue Woodard? Sue Woodard is in Europe. I believe she's in France. So she's taken this opportunity July 4th. God bless America to go to Europe. So, I don't know what that means. So please put a comment in the chat about why Sue Woodard should be in America instead of France or England on July 4th week. So we will miss her today, but I will do my best to be your master of ceremonies.
But Garth, isn't Bastille Day coming up right around now?
Oh, is that what it is? So somewhere there's a Les Mis song, and Mike Seminari's got 2 daughters, and I have 1. So we'll start.
And today's Canada Day too, Garth.
Oh, good Lord. Man, I had no earthly idea this was so. All right, sorry. So then I guess since this is the first time since you brought it up, I'd like to apologize to our viewers from Canada because I live in Fort Lauderdale, Florida, and the Florida Panthers won the hockey championship for the 2nd year in a row. So, USA, USA. So there's our July 4th celebration. So I have 2 friends with me today. Mike Seminari has been on with us in the past, and Michael Grad. Is this your inaugural Chrisman Commentary Advisory Angle podcast?
Yes, it is.
Holy cow. It's unbelievable. It's like right up there with Joe Rogan. Things just rank. It's amazing. It's like Joe Rogan.
The All In podcast?
Exactly. Scott Galloway. And then there's the Chrisman commentary from STRATMOR Group. It's incredible. It's just taken over. So let me very briefly, for those of you who've known me a long time, my DNA is origination. And my DNA, I started as a loan originator and started a .com company, but I'm really an origination guy. It's my DNA. It's my base knowledge. So I'm bringing in my partner, senior partner at STRATMOR Group to really talk about servicing because he's got a heck of a lot more experience in the servicing side of the business. And you wrote a great article, Michael Grad. Oh, for God's sakes, I got 2 Michaels. Michael Grad, put your hand up so you know which one. There we go. So Michael Grad, we're going to start with you because you wrote this great article about servicing. And so what motivated you halfway through 2025 to say, we really need to focus on the changes and the importance of servicing because it's not always the hottest topic in the mortgage banking space.
No, unfortunately, it has a pleasure to be on the call and joining the podcast. It's great to have my inaugural sort of a presentation here. But no, and certainly we all know servicing has somewhat been largely overlooked over the many, many years we've all been in the industry. So I would say certainly in the last, 18, 24 months, mortgage servicing is really experiencing a bit of a transformation and far more attention and more importantly, far more investment. So long seen as more of a back office, as long as I keep the lights on and my costs in line, everybody's pretty happy. Mortgage customer experience and servicing was not really sought after. And it really was something that was not viewed as any way to differentiate it, just sort of keep the lights on and make sure the payments and transactions are running the way they should. Obviously, we would hit certain periods of default and delinquency, given the situations we ran into in 08, 09, 11, COVID. I mean, there's certainly peaks when everybody sort of starts to dial up and get the interest, but the long-term investment, sustainable investment hasn't been there. What's changed last 18, 24 months, right? A lot of investment, a lot of attention. There's a certainly large, interest in retention, looking at the portfolio as a whole. The massive, sort of focus previously on refi and the shift to purchase has made a pretty significant shift in terms of the market. And, I'd say customer expectations are shifting, right? They've become used to an Amazon-like experience that you get, pretty much anywhere online now. And guess what? They haven't been experiencing that, within the servicing world. So there's a lot of factors, regulatory pressures. I mean, obviously are sort of, putting the spotlight on, servicing functions, procedures, processes that probably were not that closely monitored and overlooked. So a lot of factors, and again, I think we'll get into it a little bit more in the conversation, but a lot has shifted, a lot of change, and I believe where the POS, LOS, CRM has sort of garnered the large amount of investments for the last 5 to 7, 8 years. It's certainly now servicing's time to sort of take a share of that investment dollars and really look at growth, look at retention, look at MCX, and really sort of see where the servicing platform become really an avenue of growth and drive really a differentiation in the mortgage, not mortgage servicing, but in the mortgage marketplace.
So, Mr. Seminari, this is a great follow-up opportunity for you, because I think what Mr. Grad, and I never refer to you two as Misters, but there's no other way to distinguish between you at this point. So Mr. Seminari, Mr. Grad just made the point that the digital experience, like Amazon, is sort of setting a high bar. So what does our data tell us? And you wrote an article in your Insight article this month that sort of talked a little bit about the servicing experience. And I found it to be remarkable how different it is on the origination side. So why don't you share a little bit from that?
Yeah, I think what we see on the servicing side, I mean, what we've seen over the last 10, 15 years has been, like Michael said, kind of a hands-off approach. But that's, I think, because there was good revenue coming in from originations, we didn't really have to look there. And so now that we're in a slower market or a purchase market, we're looking, where's the revenue? And all of a sudden, this stat that used to be just everybody accepted 18% of retention rate, and everybody kind of thought, well, it's never going to change. There's nothing we can do about it. People are saying, well, wow, that's a big opportunity if 4 out of 5 people are not coming back for their next loan. So if you start looking at why they don't come back, you start getting into not only the servicing side experience with the frustrating IVR, changing payments, confusion, loan being sold. A lot of that plays into not having a great experience, but also the origination experience. We're looking, a lot of lenders I'm looking at or talking to are looking at, what do we do so we don't handicap that servicing experience out of the gates? Because oftentimes, even though we have this very high emotional relief at the closing, that's not really, it's not sustainable, that euphoria we feel at the closing. And more often than not, we tend to remember the things that, the bumps in the road, as opposed to just that one event at the very end.
So Michael, real quick, Mr. Seminari, real quick, what is the average NPS score on origination, and what is the average NPS for servicing overall? We'll break it down here in a couple minutes, but what is that delta? So at closing, the average customer
it's a jaw dropper. It's 77 for origination, okay. And that's pretty consistently even between purchase and refi. So you're pretty darn high. 77 is a good NPS number.
Yep.
Once you get 6 months into the servicing relationship, it drops to 23.
Good Lord.
So it just falls off a cliff.
So even if you are, so you might have, and Michael Grad, we can talk a little bit about this in a second, because I think it is one of the trends, but you may have bought the servicing experience. You might have originated it because you were the originator. You could have bought it by multiple methods, correspondent, some level of TPO. You could have just bought it in a bulk. But what you're saying, Mr. Seminari, is that there's a 50-point drop of the customer's perception of their relationship with their lender from the time they closed the loan to 6 months later through the experience.
Yeah, and that doesn't tell, I think, the whole story, because when we measure that 77, it's an artificially high number, because the whole experience is not a 77. The very end, when you get the keys to your new house, is a 77.
Right.
Or when you get the lower rate on your loan is a 77. For about a 2-week period is about all that lasts. I mean, you're celebrating. There's dopamine. There's champagne. There's like, you're just feeling all these good things. And 2 weeks later, you come off that high, and your memories are more tied to the anxiousness, the uncertainty, the doc collection, all of those things where they created strife are all of a sudden those become your core long-term memories, not that one peak experience.
Got it. And what's the breakout? And then I'm going to talk to you, Michael, Mr. Grad, about subservicing. What is our data tell us on those who service themselves versus subservicers overall?
I mean, yeah, overall, the subservicing experience is quite a bit lower. And that I think that's true of acquired loans as well. So that it's not just the fact that you didn't have a continuity in the relationship. It's that oftentimes I think that borrower feels a little bit abandoned. They feel like this wasn't my choice. I made a choice for my lender, and then 2 days after the loan, I get a new statement from somebody else. They just feel like you left them high and dry a little bit. So I think there's a little psychology in that piece of it. And then, subservicing also, you don't have the wallet share and things like that give you that extra, you know, elasticity in sentiment
Stickiness or loyalty in relationship. Yeah. So Michael, what is, Mr. Grad, what are we seeing related to on the subservicing side? Because I think, by the way, the data on this is the averages, and you should contact Mr. Seminari to get better detail. We do see some pretty disparate numbers. We get highs and we get lows, the averages in the middle. The highs are the opportunity. You can be this good.
Subservicing, to just put a number on it, was -1 versus the average was 23 NPS.
There's another 25 points. So
yeah.
So what is going on there really related to subservicing, Mr. Grad, that you see from a trend perspective? And, is it growing or not growing? What's the deal there?
Yeah, no, great. I mean, the subservicing market's growing. And again, I think trends would go along. Obviously, there has been rapid growth, mainly IMB regionals and credit unions is where we're seeing the majority of the growth. The drivers, I would say, get into a couple, 3 things. Scalability, right? I mean, if you happen to service in-house as a IMB, as an example, you need to scale, right? You need to hit a certain loan volume really to be able to sort of make things work from an economic standpoint. So the subservicing, within the IMB's scalability, right? There's the subservicers offers a scalable model. And that subservicer can adjust more quickly to, a particular IMB credit union's fluctuation and volatility in the market. Obviously, the mortgage market is highly volatile. Second factor I would say is going to drive would be just cost control, right? Outsourcing servicing can have lower fixed costs, reduce the cost of compliance, and compliance is a huge driver now of total cost, right? So players, both servicers and subservicers, again, a huge point of differentiation in the market is being able to have those advanced compliance fully automated. Again, you're starting to see now more AI-driven like compliance capabilities that run, 1,000 checks in a second versus running, 100 and during the course of the day. So there's a great differentiation in scale. And then lastly, from a driver is just the in-house expertise associated with the subservicing capabilities, right? They have deeper regulatory knowledge, deeper operational knowledge, and are learning, again, as Michael Seminari pointed out, are getting better at the CX part of servicing as it relates to subservicing. And customers, IMBs, credit unions, and credit unions are a big driver, are driving that member customer experience in terms of, what they need to require from an SLA in terms of member, MCX for those customers. So that's a big part of it right now. I mean, the in-house bank performance, right, is significant share. But again, I think the banks are sitting on more legacy platforms. They already have the scale, already have the public, the sort of the internal knowledge, and to some degree, have assets deployed across the country to handle multi-regional servicing capabilities. So there's reasons why the larger banks do have more in-house servicing.
In-house servicing. It's by the way, it's like 75 to 80% of banks use in-house. It's roughly half of IMB. So it's definitely more on the IMB side, but I think your point is many lenders are considering their options, both banks and IMBs.
Correct, exactly. And I
Yeah.
think that the banks obviously have legacy platforms. Again, a big part of it is the tech, and changing out one of those larger servicing legacy platforms is a lengthy, complicated, long-term process, given the amount of integration that goes in and out of that legacy servicing platform. So that's
Yeah.
also, I mean, the cost of transitioning is, can be large for those large players, and
Yeah.
would need a pretty significant economic, result, ROI, to make that shift.
Yeah, by the way, I do think one thing we should sort of point out, like many things, there is what happened during COVID and what happened before and after. And during that COVID period, when rates dropped significantly and volume surged, the gross margin on you could make on the loans grew so much that some independent mortgage bankers kept the servicing because they didn't need the cash. They didn't need to sell it because their gain
Right.
on sale was so good. So suddenly they, and many of them, including very large IMBs, made a strategic bet. I'm going to start retaining my servicing, forego cash today for the gain on, from the cash flows I will get from their servicing over time. And if they're good at recapturing, that's a very compelling. In fact, the 20% of mortgage companies who've made money over the last 10 quarters, a lot of them are servicers. So so that servicing was spinning off the cash that offsets maybe money they might have lost in origination. So a little bit of a rainy day fund. What happened in the last year and a half is it's gone the other way. So we may be selling our servicing we retained before for cash, or we're selling a lot more of our originations to aggregators. Thus, I'm not retaining as much in servicing. So I think a lot in the IMB side, you're seeing a lot of the fluctuations in that the changing market climate is in demand for cash from IMBs during a lower margin period. So I think that is what makes some of them, and you even I think alluded to this, Mr. Grad, was, hey, there's servicing books getting sold, and there's the big ones buying servicing books. There's always a buyer or seller, and I think some of it is that coming out of the COVID period, that the needs for cash.
Yeah, and I think too, just to add on, the the MSR sales and bulk transfers, that's driving issues back and forth. Bank exit, really bank exits and portfolio consolidation still going on. Some of the larger players, the rise of private equity, in the market as well. You're starting to see PE firms, asset managers enter, and how do they, from a servicing standpoint, so who services their loans, and that gets into new products, which would be some of the non-QM product, construction to perm, obviously a big push with, figure in the HELOC environment. So there's a lot of factors that really go in. And again, this regulatory and CFPB part of this, that is open for discussion, but still the macro regulatory requirements are going to stay in place. It would be my bet. You may see some less actual enforcement, but I believe the laws are the laws, right? I mean, you're not going to be, what is the infamous putting on the orange jumpsuit, anytime. Those things still hold.
Right. Well, and so Mr. Seminari, what are some of these blind spots in servicing, and how do they impact customer satisfaction, or however we measure that?
Yeah, so when we measure customer sat and on the servicing side, we're looking at quite a broad range of topics, from onboarding, if there's been contact, if there's what the servicing transfer experience was like with the billing and payments, escrow, all of that stuff. It not dissimilar from originations, where there's a lot falls under the communications umbrella.
Mm-hmm.
So I would say what distinguishes servicing is that more communication is better. So there's the age-old adage, you shouldn't poke a sleeping bear, but we've seen that not to really be true. The more interaction there is, the more you're on their radar, the better, and the less that they have to the more proactive you are, the less reactive you are, the better.
Yeah,
And I think that's a big place where services are falling short today, is that a lot of services I talk to, their strategy is, we will survey if they contact us, or we'll ask them how they're doing it, but we'll never proactively reach out to them. And I think that's a big mistake.
I think, so here's the other one that I think, once again, change in market climate. 64% of all consumers had their monthly payment in servicing, had their monthly payment go up last year.
Mm.
Okay, you typically think of servicing as you have a fixed rate mortgage, your monthly payment doesn't go up. Occasionally it goes up a little bit. Easily explained. What this is about: homeowners insurance and real estate tax. Real estate tax,
Yep.
if your taxes aren't kept in geographies, so suddenly your value gets this huge thing. But the insurance is an absolute staggering one. And granted, I live in Florida, so maybe I have PTSD, but whether you live in Colorado or Texas or California, all the big states, you're getting a big increase in your monthly payment. It is, as a servicer, when that escrow adjustment occurs, it's not your fault, but it doesn't matter, because the customer's experiences, their monthly payment went up. And if you can't explain it to them, they may not blame you, but they're not going to reward you by saying, well, this is a great experience. I want to go back and get my loan through this same servicer who raised my payment. So I think that's the great example. You send them an escrow analysis and hope they stay asleep so you don't have to explain it to them, because it's a bad explanation. Or, and I think the data, Mike, that you could share with people, they can reach out to you through LinkedIn or whatever, would show that's a bad idea. You ought to make sure they understand it. You ought to ask them, do they understand it? And you ought to be willing to maybe make that extra phone call to be sure they understand it. And the tricky part in servicing is that's a cost. So I'm sort of saying you're going to spend more money on servicing, which is, anathema for what servicing's always been about. But you need to do it if you want to drive high satisfaction to get that customer back the next time. Mike, Mr. Grad, do you have a comment on that?
No, great. I'm 100%. Absolutely agree. I mean, it. Not much more. You nailed it.
Yeah, thank you, Mr. Seminari.
Yeah, I would say when we look at call volume and why people call in, it's 60% of those calls are about payment or escrow, which are really kind of the same thing these days. It's and if you're sitting back reactive to that, you're not only missing a lot of the people who are slightly annoyed that you could talk down, but you're just getting the people who are mad enough to call. So it's just, at the very least, I've seen some lenders do this well. Chase actually does this well. M&T Bank does this well. As they've anticipated that call volume, put out 2-minute informational videos and made sure everybody sees them. And if you really want to be best practice, you call them and ask them if they got that email and if they watched the video and if you can answer any questions for them. But having a short informational 2-minute video can answer a lot of questions. It shows you what it looks like on the statement, why it's going up. And, originations or servicing, what we always see is if you give a why for why you need something, why you need a document, why your payment's going up, people are pretty reasonable. They understand that. They don't get too mad at you as long as there's a reason. But if it's when they get confused or don't understand, get frustrated, that's when they get disloyal.
Yeah, and I think this is, once again, if you put it in the context of I have a chance to get the next loan, this customer's payment went up is already sick. They may not blame you, and maybe you don't have a prescription for them, really. You have an explanation, but you can't fix it. But they may not even realize, exactly what happened. They may appreciate an empathetic response. And some of that may diffuse, especially if you couple with, look, I wanted to call you to walk through it to be sure you understood, because, we want you as a customer for life. And I know it's unfortunate that the insurance company increased your payments by $100 a month. I mean, that's a pretty good call. And, what do you mean they increased it by $100 a month? Well, that's what's in the escrow. Do you have that statement in front of you? I'd love to talk with you about it. I mean, to me, that's a winning call if it then turns into recapture and higher retention and the shot to get that next loan.
And you never know when one of those calls will take a turn towards, I don't know where I'm going to come up with the $300 extra a month to pay for this. Well, we have options for cash out refis, and we have options for lowering your rate, and that may turn into deals, even though you're not calling for that reason.
And by the way, so Beren from Guild just commented in the chat to me and said, especially if you're going to offer them maybe some insurance options to be sure they're the right ones. That's a great point. I mean, not everybody's going to be involved in the insurance business, but if you have, you know, a package that enables them to maybe shop or get their options or whatever, boy, that's, you know, now you've gone from, you know, somebody who's anxious about it and you're the hero. That's a great one. Thank you so much for putting that in the chat. By the way, I do want to encourage you people to use the chat if you like. Oh, here you go. So, you know, Joe Delene's escrow shortage this past month was $3,000. Dude, hold my beer. My insurance went from $8,000 a year to 18, Joe. So come on, man. Like, that's
I was going to weigh in just on that comment too. That you're starting to see the platforms, you know, add these, you know, upsell, cross-sell, just sort of, you know, relationship deepening product sets, either through their entity itself or through technology and other partnerships, business partners. So I think you're going to see more of that access and that outreach within the servicing portfolio, within the servicing platforms, to be able to sort of look at ancillary products. Right now, where is the value add and what's the right timing? What's the value prop? What's the sequencing, the process by which that's done that creates the right member experience, customer experience? You know, people are working that, but it is going to continue to grow where you will be able to have a revenue generating component, you know, out of that servicing platform.
Yeah, and I think a brilliant one, like if you're a depository, the relationship at stake, we've been talking about recapture, you know, and that's in a depository thing and an IMB thing, but in the depository, it's the entire relationship. So, you know, it's really worth the extra phone call from my perspective to do it. And by the way, I wanted to say, feel free to use the chat if anybody has any calls or thoughts or questions related to what we're talking about.
Something just came in from Laura as well, Garth. I don't know if you just saw that. It looks.
Yeah, I'll take a look. You can take a look at that one. I told you I'm the origination guy, so I'm not quite sure what that question's about, but I'll let you flag it. So the other sort of item, what are the other items in the customer sat item Seminari that you see? So we talked about escrow. We talked about you called because you're a problem. What about the onboarding experience?
Yeah, the onboarding. So that's the one that probably creates the biggest delta between the owned and the non-owned experience, right? Because there's just no continuity there. That's where we see the biggest difference when we go from surveying and getting that NPS at closing to 6 months later or 12 months later. Some of the other ones kind of stay even, but that one really drops. And so what are some ideas that could help that? Most people, their experiences, they get a statement in the mail or they get an email or something, and that's it. Nobody calls them. Nobody, talks to them. Some people have an onboarding call or somebody leaves them a voicemail, but no one's really checking in 30 days, 90 days later. So the companies who do this well, I think, call 30, 60, or 90, you pick, days later, and ask, how has your experience been with us so far? Has anything been frustrating, anything confusing? And just have that check-in call to establish relationship. Some people call it, a warm hug, welcome to the company, to the new servicing experience. That tells you that you weren't just abandoned and now you're with this nameless, faceless organization, but actually somebody at the new organization cares about you. So I think that's a big opportunity. It may cost something, but it's not a huge cost to just be able to give everybody a phone call at that 90-day mark.
Got it.
Mhm.
Okay, so one comment David asked, at what annual volume does servicing make sense to consider? And I take that, and Grad, you can handle the second. If one is, at what annual origination volume should you consider retaining servicing as part of your best execution strategy? Well, there's a few things there. Number one, you got to have a Fannie, Freddie, Ginnie, or whatever servicing you're retaining ticket, the ability to do it. That is generally lenders who are $1 billion plus or 5,000 loans, let's say 3,000 to 4,000 loans a year. I know it's not absolute, but generally when you're sub $1 billion, it's hard to have enough flow that is likely to make best execution around retention of servicing. Like I said, there's exceptions probably on this call to that rule, but that's one. And I don't know if that's helpful. The second question, and maybe David, what you were sort of asking is, at what point, what number do people generally look at doing in-house servicing versus subservicing? So is there a number of units, number of loans, Mr. Grad, that normally that comes into?
Yeah, again, everything's, again, I'll say not absolute exceptions, but I mean, the numbers being reduced over time would be my view right now. I mean, if you're in the business, 10, 15 years ago, I mean, the general number that was thrown around was 40,000, 50,000 units.
Yeah.
I think that number is getting less. I mean, because of the platform, because of the types of, and even from a break even, just pure economics, I think the tech investments that are occurring and just sort of the positioning in terms of the pace that you can get those folks onboarded and in-house, I think that number is probably getting closer, to 30,000. I mean, there's some that are doing it for less. I mean,
Yeah, there is.
I would say in some cases, it's totally then driven by 100% customer experience, member experience. Some of those are credit unions that are pushing the envelope, but they want to control that member experience. They want to have that, credit union look and feel to, the customers and the stickiness. But that'd be, again, numbers, again, we do a fair amount of work on just analysis and cost to serve, and we can zero in on that. But I'd say those are, that 30,000 units is a number, I mean, that we at least start with, and then work up or down from there, just depending on the current client situation, current lender situation, and existing assets they may have or availability to actually bring that in-house.
Yeah.
If they've ever done servicing before. I mean, there's a lot of factors that go into it that are they close to a servicing, sort of regional capabilities? You look at, sort of the, Michigan area, right? A lot of servicing folks, a lot of, displacement. So a variety of factors go into that break-even analysis.
That's awesome. Hey, by the way, the other question is, if you're a big servicer, we already are surveying, Mr. Seminari, customers from most of the large servicers. So we actually have a whole survey process where we ask consumers every quarter, who's your servicer? What happened? How do you feel about it? So if there are any large lenders on this group, reach out to LinkedIn or on the STRATMOR website, or send Michael Seminari, pretty easy to find. He's got a unique name, at STRATMOR Group, an email, and he may have data about your company and he could talk you through it. Because the one thing I want to stress, there are lenders, servicers who have high satisfaction. It's possible. It's big swings. So while we're talking about things that on average create problems, they don't have to be problems if they're handled correctly. I think that's really one of the big messages and big opportunities on how to differentiate yourself, is to try to drive higher levels of satisfaction or mitigate the impacts on these low satisfaction moments when they occur.
Hey, Garth, and just one point on that. I mean, obviously, with your, origination heritage and DNA, we do a lot of work now with secret shopping on the front end of this, process.
Yeah. Again,
I think all the focus, all the attention from MCX, I mean, obviously, secret shopping on the servicing experience is, I think, going to just be another area that is going to get a lot of attention.
Yeah, well,
right?
and and we do, Michael's referring to the secret shopper program that we do, where we go in and actually pretend like we're consumers, and we do it on behalf of lenders to experience what the customer does when they interact with you. We actually do that from a servicing perspective too. Especially that round trip back to origination, meaning I'm online, I check my payments, I'm trying to figure out, can I save money on a refinance? Can I get that answer? Because that's a classic secret shopper where we as an industry will think, well, all you got to do is go to our calculator and punch some numbers in and it'll tell you, well, can I find your calculator? Does it pre-fill? Does it automatically bring in the information of my current loan, or does it ask me my interest rate when, wait a minute, I was just in my servicing thing? I mean, that's what a secret shopper thing will reveal. And all of those are another ways of saying to a consumer, you're not that important to me. And, you know, whereas instead of having this opportunity to say, I'm here to help you with your next loan. So I think that's a good point, Mr. Grad. I don't think I've ever said Mr. so many times since I've been at church with my parents.
There's another good comment, Garth. Where and how can technology alleviate some of the customer stat challenges discussed earlier? So that's, to me, that's kind of a two-part conversation, maybe even three. But there's different phases where we measure and where technology can come in. And so I'll just mention two of the places. One, I think mid-process of origination. So with the aim of teeing up the servicing relationship to be good, right? You have to have a good origination process. And a lot of lenders will come to me and say, well, we need to survey in the middle of the process to check in and see if things are going well. And my response is typically, you don't need a survey to do that. It shouldn't even be a survey to do that. People get survey fatigue if you over survey them. What you need in the middle of the origination process is a CRM email that just goes out automatically. And it's not a survey. It just says, hey, just wanted to check in, make sure we're doing things right and that this is going in a good direction. And if there's anything we could be doing better or serving you better, we want to know. And then it's just open-ended like that, and let them say what they want to say. That's not a survey. You don't need to measure NPS or OSAT or anything like that in the middle of that process. That's something most people already have technology available for. So that's one place I would recommend it. The second would be, this is a little self-serving, but the tool that we have at MortgageCX puts data into a personalized format. So technology or some program where you can take your customer feedback and actually personalize it to your employees, because you can preach about it all day long from the mountaintop of the sea level, and it will never trickle down and make its way down to actually creating behavioral change at a processor level, at a loan officer level, at a call center rep level. It has to be personalized to them. They have to see their impact, their own impact, and a clear path to improvement. So that's something that our program does, but I feel like we've seen the needle move. We've seen companies double their NPS in the course of 12 months by focusing on the process aspects. The process, in origination, it's 4-to-1 importance of the process versus the actual originator relationship. We've run the numbers on all of this, and that impact that the process has is far and away more important in creating loyalty and advocacy. So those would be the two places that I would mention. I'm sure there's more. Garth, I think you're muted. Yeah.
Thank you. We're coming towards the end here. By the way, these are supposed to be 30 minutes, and I don't believe we've ever done one for 30 minutes. So I will take the blame for that because, I'm the one who probably does most of the talking most of the time. But Mr. Grad, any other final comments? And what's been sort of the reception to your article of, checkpoint or checkmate related to servicing? And by the way, the article link is up in the chat. So if anybody wants to see it, you can go ahead and click on the article, and I'll go ahead and put it back down below.
Yeah, no, thank you, Garth. Yeah, no, I appreciate everybody's time. And really the article, a lot of positive responses coming back. Both, agreeing, 100% agreement, and there's just a lot of questions, in terms of the industry, the pace of change, a lot of questions came in on just AI and, how's AI going to really be? I mean, it's a question that we get every single day. Everybody on this call gets that question every single day. But that's a big emerging player in this, and we're starting to see some of the use cases come out as, really focus themselves on servicing more so than a lot of focus in the servicing area. So main primary use cases there: document automation, loss mitigation and default automation is another big focus. We got QC. I mean, really trying to eliminate QC altogether. Compliance search via conversational AI. I mean, so there's a lot of activity going on there. So I mean, it's a target-rich area in terms of some of the AI capabilities. And again, I tend to be a huge lead with process. So getting the process understood and redesigned to match growth, retention, MCX is goal one, and then apply the enabling technology, whether that be AI, whether that be any other tools, workflow tools, is where you really pick up the greatest amount of lift.
That's awesome. By the way, so let's go back. Sue Woodard, we all missed today because she's in Europe. What are you doing for the 4th of July, Mr. Grad?
Oh, it's my wife's birthday, so on the 4th, so we do a big lobster fest. So
wow, look at you. You get to double dip the birthday July 4th combo. Mr. Seminari, where's your family taking you?
We'll be watching fireworks over the valley that we overlook, so we can see like 4 or 5 different fireworks displays. But because my kids are still only 4 and 6 years old, we're not into the late night going out to the fireworks. we're still staying home.
Exactly. So seeing as how it's California, and my daughter lives in California, adult daughter, I'd appreciate if none of those embers end up lighting anything on fire. So, let's hope for a safe July 4th there in California. Right. And I'll be on the beach in Fort Lauderdale where we shoot them out over the beach and hope there's no ocean breeze pushing them right back to us. So there you go. So appreciate everybody. Feel free to check out Mr. Grad's article. Reach out to Mr. Seminari related to additional information on the customer experience, because I'm pretty sure that's what this is all about. And we really appreciate you all joining us, and we'll see you next month at the Chrisman Advisory Angle. Thank you.
Thank you.
Thanks.